Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. This is the weekend edition where we interview notable people from the world of real estate investing. Today's no exception. We have a great guest. But first, a quick thank you to our sponsor. The Real Estate Espresso Podcast is brought to you by International Coffee Farms. International Coffee Farms grows and sells specialty coffee in Boquete, Panama. They now have 11 fully operational coffee farms, and they are 100% sold out. They are accepting reservations for farm number 12. If the idea of owning a safe, diversified offshore investment is intriguing to you, check out International Coffee Farms at internationalcoffeefarms.com. That's internationalcoffeefarms.com. We are back. Here on the weekend edition, we interview notable people from the world of real estate investing. Today's no exception. We have a great guest. All the way from Indianapolis, Indiana. Welcome to the show, Jeff Schechter.
Thank you so much, Victor. I'm happy to be here.
So, Jeff, give us a little bit of your origin story. How did you get into this crazy world of real estate investing? And maybe some of our listeners don't know you well, so why don't we start there?
Yeah, that's great. I basically just started as a scrappy guy. I came from a very traditional background and had a very difficult time fitting into the mold that was designed for me. And so I became very, very entrepreneurial even in my late teens, early 20s, and pretty much self-employed almost my whole life. I would occasionally have some other sales jobs and things like that to pay the bills. But for the most part, I've always been in business for myself. And even back as far as in the late 80s, I was house hacking and, living in houses and fixing them up and staying there for a couple of years and then reselling them. And this was before the term house hacking was even popular. And I just always had an interest in it. And I felt like in the world of real estate, there was better opportunity just because the numbers are so much bigger than, say, selling a pair of jeans or something like that. So, I was drawn to that and the value add. And I've been in a number of different capacities within the world of real estate investing, but it's always been fun and intriguing for me.
I love that. There's so many people that I talk to where I hear a very similar story, that the traditional mold, go to school, get a good job, all of that sort of thing, didn't necessarily fit. In my case, I actually did go to school. I did get a good job, and I went that traditional path. And after 25 years in corporate America, decided to take a hard left turn. So there's no one set way to do this, but your story is remarkably common. And, I think it really shows what's possible, that you don't have to do it any particular way. There is no prescribed formula.
Yeah, agreed.
So you're based now in Indianapolis. How did you end up there?
Well, I'm mostly a Texan from the standpoint of my adult life, but I came here because I started a really nice turnkey operation with a guy who was actually a client of mine. And we had just had some great energy and some good ideas, and we saw what was going on, not just in Indianapolis specifically, but within the world of turnkey, and also having a background in digital marketing. We saw what was going on in the digital marketing world, and we just recognized that there was a really big opportunity, a convergence, as it will, of some different technologies and different, sets of circumstances that would allow us to do what we do, in many cases, better than a lot of our competitors. So that's really the short version. And about 2.5 years ago, I moved up to Indy, and still getting used to the cold winters, but it's been a fun ride.
We're obviously in the midst of a market cycle. We've had quite a substantial run-up, starting probably at the bottom, 2010, 2011. A lot of people think we're in the fourth quarter of that cycle. Have you found it more difficult to create value? Are the numbers still working? Have you had to be a lot more selective? What's your perspective?
Well, in our world, actually not really. I'm not disagreeing with you that we are in the fourth quarter in general, if you look at things, kind of on a global scale. Within a city like Indianapolis, which is a big Midwestern city, this is not an area that's ever had fantastic appreciation, other than in those little fancy pockets where there's a lot of gentrification. So overall, there's not the big peaks and valleys like we're seeing in the other cities. Further, in more of the specific areas that we operate, because we tend to operate more in C-class areas. And, like just to put things in perspective, we're selling, finished rehab single family homes to investors for $50,000. And I know sometimes your listeners will go, "Oh my God, that's just crazy," but that's the reality of what's going on here. So even in a downturn, we don't necessarily really care, and all the stuff that we're doing is, within 5 to 20 minutes of downtown. So there's always an easy rental market for the properties that we have, and we're focused strictly on cash flow. We're, very much in the buy and hold world. We're not even necessarily looking for appreciation because we want the money now. We want it every month, and that model has really worked well for us in those price points and in those kinds of property classes. So we figured out a way to somewhat insulate ourselves from that.
Again, for the listeners at home, there's no one set way to do this. One of the things that I've discovered, what's been my personal experience, I've never, ever lost money in A-class or B-class property, but I actually have lost money in C-class property. And I think one of the reasons for that, well, a couple of reasons. Number one, when your rents are low, if your air conditioner dies, your air conditioner doesn't care how much rent you're going to get. And how long it's going to take you to replace that air conditioner or your water heater or whatever needs maintenance. And so what I've discovered is maintenance costs have sometimes killed a deal. What's been your experience? How have you overcome that?
Yeah, I can totally see that. And I hear from a lot of investors that they have not necessarily been able to make C-class work. Particular to what we're doing, we don't really even operate any properties that even have air conditioning. So our tenants typically are putting in their own window air units and oftentimes, getting their own appliances and things like that. So, granted, this is more of a blue collar working class type tenant. Probably the biggest challenge that we have is collections, but we have very aggressive collections efforts. And because of the way we manage, we've been able to make it work. So some of that is, obvious. C-class could be priced differently and have a different price to rent ratio varying from city to city because of just the tremendous price to rent ratios that we're able to do. We find it works really well. So, for example, in our area, with $150,000, you could buy, a nice B-class brick suburban home, and that would make for, a nice rental. And you'd probably get, $1,100 or $1,200 a month with one door. But for the same $150K, you could definitely buy 3 singles in more of the C-class neighborhood. So now you've got 3 doors, and you've got $700 to $750 rent on each one of those. So that the ratio is just so ridiculously different that it more than makes up for any maintenance issues. What we also find in a city like this, because the price points are lower, we're seeing just as big, sometimes if not bigger, vacancy rates in that B class because that renter has got a pretty decent credit. And they start looking at paying $1,100 or $1,200 a month for rent, and they go, heck, I can buy something for that. And so in those times where we've been in the B class areas, we've often lost renters to them going out and purchasing their own properties. Whereas with the C class, and these people have, obviously shakier credit, and, it's a little bit more difficult going through the vetting process of a tenant. But once we get somebody in there, they're, kind of in that culture. And again, it's not a judgment call, just an observation, but they're in that culture that they're never going to own a home. They're living hand to mouth. They are lifelong renters, and we get very, very excited about working with lifelong renters because it works really well with our model.
That's a very interesting insight. It's true that part of the competition for tenants is people buying their own home, especially in an environment of very low interest rates, which we've had for close to a decade now. And some would even argue that we're going to see low interest rates again in the not too distant future. What are your thoughts on return on time? So you've talked about return on investment. One of the perspectives that I often share is that for me, someone who's putting deals together, raising capital, whether it's a 1-unit home, a 10-unit building, or a 100-unit building, the effort, from my perspective, is almost the same. And so how would you talk to somebody on the whole question of return on time?
Well, it's a good point, Victor. I'm not completely sure how to answer the question. And obviously, I'm a little bit jaded because I operate a very, very successful turnkey company. So, the value add for our investors is that there really is very little time once you kind of get that you're in a good, big American city that's got employers and good stability and not a lot of peaks and valleys, and, we're doing everything for the investor. We're going out and acquiring and rehabbing and calling in a third-party inspector and curing any inspection items and tenanting and managing. They don't have a lot of time involved in finding the deal. It's really just a matter of establishing the relationship and establishing the trust. And, once they kind of get that we're staying within a very narrow lane of what we do because we've perfected our system, it's just a matter of saying yes or no to the properties that we make available to them. So, oftentimes the due diligence on the part of the investor is, an hour, 2 hours. I mean, it's not really a big deal. And I agree with you about your assessment of, multi-doors and larger deals probably taking the same amount of time to set up. Well, we just don't, in our business model and what we're serving up to investors, we're just not necessarily serving up multifamily properties. We tend to stay into the mostly single family homes and the occasional duplex, mostly because we find that there is a huge sort of problem in that 2, 3, 4 door all the way up to like 30 door size within C-class, because that is really problematic to manage. It just becomes very difficult. So unless you start moving up into those bigger apartment buildings where there's some more amenities, there isn't really anything to attract a tenant that's going to stay for any length of time.
That's a very interesting insight. So what are the problems that you see in those medium-sized buildings? Is it that you get a collection of lower quality tenants and they feed off each other in a negative way, or what's been your experience?
Well, that's part of it. Yeah, you definitely have some of that. What's interesting is that $100 or $150 a month in our market can make a significant difference. So, for example, little single family home, 3 bedroom, 1 bath, maybe it's 900,000 square feet, and it's going to rent for $700, $750, something like that. That's no problem to put a family in there. And, you may have a husband, wife, couple of kids, single mom, whatever. But they look at that and go, if the place is decent, clean, and kept up and managed well, they're probably going to stay for a very, very long time. The moment that you add another wall between two people and you go to a duplex, even on that same street, even next door, we now have, instead of $700 or $750 rent, we now have $600. And the person that $100 or $150 starts making a difference to is of a different quality type person. They're just more difficult to deal with. And so then as you get into like these 3 and 4 and 5 plexes where the rents are at, $450, $500, the renters really they're just garbage. I mean, I don't like to talk about human beings as garbage, but they're just really, really problematic and really difficult to deal with. They're in the position that they're in because they don't treat themselves or their lives or anything else around them with any kind of respect. So, we've just found, as aforementioned, C-class is challenging enough, and we do a very good job with C-class, but we don't want to cross that line and be in C-. And that's where it starts getting really troublesome.
I get that. So that's another very powerful insight. So your tenants are basically looking to maximize the value for the dollar as opposed to paying the minimum amount of rent, because those are not the same thing.
No, they're not the same. Maximizing the amount of dollar obviously still has to be within their budget and within affordability. But you make a very, very key point, and I 100% agree with that statement. I
love that. So, if folks want to get in touch with you, what's the best way?
Just go to our website. It's very simple, highreturnrealestate.com.
Fantastic. Well, Jeff, great to connect with you. Great to catch up. And I love what you're doing. I think it makes a lot of sense. You've developed some very strong systems. And despite what you said, you actually did a very good job of answering the question on return on time, because you've developed the systems to make the use of your time efficient, and in particular, the use of your investors' time efficient. So I love that. I think that's great stuff.
Yeah, thanks.
So in the meantime, for the listeners at home, definitely check out Jeff at highreturnrealestate.com and have a look at the Indianapolis market. There may be some very, very interesting opportunities for you there. In the meantime, have an awesome rest of your weekend. Go make some great things happen, and we'll talk to you again tomorrow.